All right, I think everyone's on the screen now. Well, an exciting time. Let's kick it off with a few questions. I'd like to go round robin in this particular question. So I'll call each person as your turn to answer this particular question. So the question goes like this. There's been a lot of discussion about long live the city. Some people believe that they no longer need to be within close proximity of cities. And there are also discussions on making cities more livable and sustainable. In your opinion, what will be the future of cities and urbanization post-pandemic? What will livable cities look like post-pandemic? I guess with this question, we can start off with Carson.
Yeah, thanks. Well, first and foremost, I think we need to say that cities are for the people, and this is clearly something we've realized during the lockdown when some cities were turned into sleeping giants, especially the business districts. So when you have parts of the city where no people live, then this is clearly detrimental for the city overall. And we've already heard before that there are developments going into the direction of to reshape and redefine the city. So livability, of course, is something which relates to many factors: housing, safety, accessibility to basic services such as electricity, water, leisure, culture, all these things. And of course, they play different roles in different cities in the world. So you need to consider these kind of special factors when you make up your mind what livable is. Sustainability relates, in my view, very much to the city's resource use and their overall footprint. And again, here, I mean, not all cities are created equal, but generally, we are under the impression that technology trends are transforming the cities in the sense that they are not becoming smarter. I mean, there's this buzzword of smart cities, which we hear quite a few times. But the smartness can be used to make the cities more sustainable in the sense that water and waste management is being done in a more efficient way, that traffic is routed in a more efficient way, and that in the very long run, we actually remove some cars from the streets because we are using autonomously driving cars, at least in the world's cities. So these are some of the aspects we look at when we think about livable and sustainable cities, because at the end of the day, those two go hand in hand. If cities are safer, if they are cleaner, if they are calmer, they are more sustainable, but they are also more livable.
Thanks for that, Carson. I think we can ask the same question to Liam. What are your thoughts on this?
Thank you very much. I think that the first point I'd make is that cities will thrive. I mean, primarily because there's no option. I mean, we've documented that, lots of affluent people have left places like New York or London, and they've been looking at the suburbs and beyond as alternative locations for their families through the pandemic. I think our conclusion is probably these are plans that would have happened in the next one to 3 years, but they were brought forward by the pandemic. So kind of decision making was kind of accelerated. But the reality is for everybody else, for the vast majority of the population, you don't have that option. And actually, not everyone wants to have a very long commute, and not actually everyone works in an office where they can potentially work from home. So I don't think there's a really big option here. The other thing, actually, just touching on what Carson said, is cities are the sustainable option. Actually, if everyone was to move remote and live in the middle of nowhere, actually it would be unbelievably unsustainable. So actually, in terms of government policy and government requirements, making cities work is a really necessary thing to happen. I think there's lots of positives. Rick touched on it in terms of mixed use, making CBDs more livable and all those kind of things. I think that's really good, and it's definitely happening in many locations. The one area that I think there is a real opportunity for investors, entrepreneurs, etc., is around skills. So actually the ability to develop really good quality mixed use sustainable development is quite a rare skill set. I see it done well in a few places. I see it done badly in lots of locations. And I think actually one of the biggest challenges we have in the West, but also globally, is actually this kind of change of use of some office space, not all of it, but some office space, retail space being changed into residential, into logistics, etc. There are some big challenges coming, some big opportunities, but actually to do it well requires a really kind of deep relationship between the public and the private sector. And those cities that kind of get that balance right, I think, will do very well. And if you get it wrong, I think the outcome could be quite negative.
Yeah, so it's like we keep the cities, but we have that level of refurbishment or repurposing or rejuvenation of some areas to make it more sustainable and livable.
Yeah.
All right. Rick, the same question regarding livable cities.
Yeah, I agree with Carson and Liam. I think the city is got to come back. I think in the Philippines, you're going to see eventually, as the vaccine gets rolled out, BPOs will continue to move their staff from homes back into the office. Call centers will continue to expand. I think you'll probably see more labor shortages actually in places like the US and Europe. So more outsourcing activity coming out our way just because people can't cross borders. I think also with cities will come back. I think it will. I mean, people will want to be outside, right? I think you're seeing that now as good weather approaches and people want to get outside. They want to breathe, so sustainable cities, it used to be a nice to have, people always talk about, being, having, inclusivity and sustainability and ESG and safety. But now I think they actually really mean it and have to live by it. So if you're going to cities of the future, or even the Philippines, you've got bike lanes, you've got green space, you've got breathable space. So I think it actually could be quite a positive trend. I don't think we want it to go back to, chock-a-block traffic where, you're stuck on EDSA for hours and hours. So I think a lot of people now will continue to work and be in the office, but you'll see more decentralization. You'll see more centralization of people that want to be in the urban core and don't want to go on those commutes. You'll see people that won't want to sit in traffic for 2 hours and either stay in the area where they work. Also, education is going to be key as well. If you look at the main drivers, why is Silicon Valley successful? Because it's got the Berkeleys and the Stanfords and the Santa Clara. There's got the good skill sets in the venture capital areas. So a lot of it will be around education as well. A lot of educational institutions have really struggled if they haven't been able to go online. So I think this online, offline, complementary setup is going to be key. So I think offices will return. I think they return in a different manner, and they'll also be able to embrace the technology that's whether it's Zoom calls or MS Team calls. So I think you'll have a much more actually efficient workforce and probably a little bit more balanced workforce once we come back into the offices. But cities will definitely return, and hopefully in the Philippines it will return on a little more humane basis, a little bit more decentralized basis, and a basis where it's much more sustainable and green. And I think also occupiers will demand that, and also investors will demand that.
Thanks, Rick. Before we proceed, I'd like to take this time for the audience to look at your screens. There will be a poll question for you to answer. So just there is a question there. We'd love your feedback on it. I think we can now proceed to the next question as the others or as the audience answers that poll. Okay, so what are the real estate opportunities you see in 2021 and post-pandemic? Which real estate asset classes will thrive? What is your outlook for specialist sectors? We know that some sectors are doing quite well, but we'd like to know your thoughts on it, such as data centers, industrial and logistics, co-living and co-working. So I think this question regarding the real estate asset classes, the top 5, I'll throw this off first to Liam.
Thank you, Cash. I think there are lots of opportunity areas. I mean, you mentioned data centers. It's one that's been talked about quite a bit, and actually for a good reason. The London market for data centers is Europe's largest market, and demand rose by 60% in 2020. So you can kind of see the impact of the pandemic on data usage and so on, and understand why it's been such a growth sector. The problem that you have with the data center sector is that it's a relatively niche sector. The size and scale of the sector isn't particularly big, although it is growing rapidly. You've also got the issue that it's quite a technical sector in terms of the costs of setting up and equipping data centers. So actually, the access to power, security, air conditioning, etc. It's not an easy product to bring to market. But it's certainly an area that will see growth. I think the other area which is quite interesting at the moment is the sort of institutional residential. So certainly in the UK and in European markets, we've seen a big growth in the student accommodation. And actually, ironically, despite the pandemic, actually UK student accommodation has been quite a strong sector this year in terms of occupancy. But the other areas are things like retirement. So actually sort of purpose-built retirement accommodation. It's relatively embryonic in most European markets. It's quite mature in the US and Canada and Australia, but there is lots of growth potential for some of those sectors as well. I think it's an interesting point that we touched on in a previous wealth report, talking about the evolution of the added value property. So actually, as we see yields squeeze and as we enter a low inflationary, low interest rate environment, the value of service, the ability to add value through branding and service, etc., becomes ever more important to try and improve your yield and your return on investment. And those sectors where you've got kind of managed services around residential property, I think are quite an interesting prospect over the next few years.
That's good to hear. Rick, what do you think? What are the real estate asset classes that will thrive?
Yeah, I think I went over a number of those in my presentation, but I think other things, data centers will come in to the fray, especially in the medium term. That's we're seeing a lot more interest in data centers, which don't require people, and so they're COVID proof. They just need antivirus software. That's all they need. So we'll see the growth in data centers. The whole serviced office concept, I think developers might take that in-house and look to do that, some of that themselves. In terms of retail conversions, hotel conversions, you look for people to, what do they want to do with their hotels? They want to turn that into medical space, to turn those into hospital rooms, et cetera, for the short term or medium term. I think you will eventually see a boom in travel as well. Once people have the opportunity to get out, the vaccine's been rolled out, they're healthy, you'll see inbound travelers, you'll see outbound travelers. I think that will come back. I think also big opportunities in this sector is probably to partner with foreign players, foreign institutional capital, equity, foreign institutional debt, real estate investment trusts. Use those mechanisms because you can't just do it with your own cash. Also, I think this is very, very clear as well. We haven't seen this before. Is in order to understand the office market, you need to deeply understand the residential market because now they are deeply entwined. And I agree with Liam. Residential is going to be a very institutional classes, whether it's multifamily, institutional, but residential is also proved as a bellwether. I look at transactions every day, and you see residential transactions in this kind of market. Even though you've seen in condos, you've seen condo prices drop and lease rates drop, you've seen volume increase. And even though houses in the villages have held their value, you've seen a lot more of them trade, even if it's the same value, like maybe never before. Payment terms have changed. So institutional and convergence between institutional office and office institutional, that's crucial. So if somebody just says, hey, listen, we don't do residential, we only do office, then you can tell them you don't understand the market. You really need to understand both. Great to understand all the sectors, but now you really need us to understand the office and residential, because at some point, everybody on the call, everybody in the audience has been forced to work from home.
Those are good insights. But well, looking at a bigger scale, like in looking at more than real estate, I think I'd like to ask Karsten this question, a follow-up question, like how did other asset classes beyond real estate perform in 2020 in your research? And what is your outlook in 2021 and beyond?
Well, actually, looking back at 2020, as strange as it may sound, all risky assets have performed well. Let's say after that spring sell-off we had, and equities were clearly the outperformer, given that many global indices reached new all-time highs. More specifically, if we look back at 2020 from my own perspective as a thematic researcher, it has clearly been the year of thematic investing, because many of these investment themes we have been looking at for years, they really started to fly in 2020. And this is primarily because the COVID crisis accelerated existing structural trends, such as the shift from offline to online. For 2021, we remain constructive overall for risky assets because we think that the economic recovery will continue from that recession we had in the last year. And our optimism is primarily based on the vaccine progress, of course. I mean, we see it in countries which are well vaccinated, that they are opening up, that they are returning to normal. And we see another source of support from fiscal and monetary policy by governments and also central banks. So from our perspective, 2021 is a very favorable backdrop for risky assets overall. And in terms of investment themes, I'd say it's basically the ones we've been highlighting last year as well: future cities, future mobility, cloud computing, artificial intelligence, cybersecurity, and then also, of course, digital health and genomics, because we are still fighting this pandemic.
Wow. Actually, like, sounds very optimistic,
Indeed,
but I mean, like, we're seeing more opportunities even though we're in a pandemic. I get before I go to the next question, I think we'll have another poll question on your screens for the audiences. This is related to some of the second homes that you're looking at, or what are the criteria that you're looking at for your second home? And hoping you could answer, the audience could answer that. Okay, so for our next question, I'd like to ask Rick this, because this was in his presentation earlier, that there was an increasing demand for secondary homes outside Metro Manila. One of the examples was Batangas. Rick, do you think this trend will continue after 2021?
Yes, I think that I think it will continue after 2021. I think a lot of the high net worth individuals will be very leery about getting back on a plane in the short term. Some of them have discovered that they're very happy just instead of. I know a lot of friends, high net worth individuals that anytime they had a chance, they'd hop on a plane to San Francisco or Hong Kong or Tokyo or London or New York, and they would neglect going to doing domestic tourism. So I think a lot of those folks, and some they've had family houses for years on the Batangas coast that they've actually never been to in 10 years. So I think you'll see a lot more of those people staying closer to home and realizing that building on that second home, you've seen prices increase. And I think that will continue. Also with the infrastructure getting much better, it's much quicker to get to some of these destinations, and a lot of them have been under touristed and underdeveloped. So you'll see a lot more activity there. So yeah, I think that will continue. And I think there'll be a lot more domestic travel. And yeah, some people will hop on planes again, et cetera. But I think that sparked another option. And also global travel keeps getting more difficult, and it's not hassle-free. So I think this will be a great shot in the arm for domestic tourism, especially for the high net worth investor.
Got it. Thanks, Rick. I think for this question, I can direct this to Karsten. One of the biggest impacts of the pandemic has been on the ways people work, right? The question is remote work sustainable for organizations? Will we see a return to pre-pandemic work setups after COVID-19?
Well, by now, I'd say we are all aware of the advantages and disadvantages of working from home. So I don't want to go too much into that. But for me, the key point is that, of course, it increases flexibility, especially if you want to manage your family, if you need to manage your family, if you want to avoid long commuting times, for example. But it blurs the boundaries between private life and work life. And this is the key consideration for me when it comes to work from home. So what will the future of work be? Well, as often in life, it will not be black or white. It will be not home or office. The future will be a blend of the two, combining the advantages while minimizing the disadvantages. And by that, I mean that when there are days where you don't have any physical meetings, in my case, when I'm writing reports, when I'm doing research, I can do that very well from home. But when there is client meetings, when there is interaction needed with colleagues, it's much more efficient to be in the office because you do have these informal conversation as well, right? Meeting somebody at the coffee machine, bumping into somebody on the aisle. This is a clear advantage of being in the office. And I'd go so far to say that the efficiency we've shown while working from home initially during this crisis was largely related to first the urgency, because we realized there was no other option than being productive in the home office. And also the fact that we could build on relationships we had established in the past. But think about setting up a new business, setting up a new team, recruiting people, and doing that all remotely. That is much more difficult than in a personal interaction. And then that's why I believe the future of work will be clearly a blend of the two, which of course has implications for office demand, as we've heard earlier.
Thanks, Carsten. I think I'd also like to know, the thoughts of Rick, having a company with more than one, with about 1,400 people. What is your experience with remote work? And do you also think that it's sustainable for organizations?
Yeah, I think I think there's a place for work from home. It kind of depends what type of business you're in. I mean, I think if you're a software development company or you have some brilliant software developer, you can probably work from anywhere. I think the human element is key, and I think the human element, especially in a service business, is really that secret sauce. So what you found is just with we've all many of us have kids on the phone. I think this whole online school, it just doesn't work very well, right? So if your kids can't do it, they haven't met the professors or their teachers. Yeah, I mean, even if you have the best online systems, you still miss that human interaction. I think, going through a couple different iterations of work from home is where everybody had to work from home, and then we had a skeleton workforce, and we brought people back in. You didn't realize how much you were missing in terms of those conversations and whatnot. So, and also to start a new company be very difficult. New companies, new teams. So it takes years to build up that trust and via human interaction. Also, from a investment standpoint, I mean, a lot of deals, I mean, big ones are just saying, hey, listen, we're not going to spend hundreds of millions of dollars investing if we've never seen the property up close, if we haven't met the management team that's been running it up close. We're not going to fund this developer if we hadn't sat across the table and done our due diligence in person. So that's really slowed things down. I think if you've done deals in the past, repeat deals, recapitalization deals, re-upping, but I think new deals, fresh deals, whether it's real estate, corporate M&A, et cetera, people want to have that interaction face to face. And that same experience, we've had that within the company as well. We've had to do it, and we've been good at it because we have to do it. But I think at the end of the day, we're not robots, we're human beings, and that's their ability to reason, interact. And I think also the psychological toll is also is starting to show as well. Some people really miss that human interaction. They're isolated at home. They're in a condo, so it's almost like putting somebody in solitary confinement. So, and you can only stay in solitary confinement for about 40 days before stuff really starts going wrong. So, yeah, let's get everybody back in the office.
Thanks for that, Rick. I also saw earlier in the presentation, there's this graph wherein, how much $1 million could buy when it comes to residential luxury projects. I think this is a question that we'd like to ask everyone, is that if you were to have $100 million to invest today, where would you put your money? I think we'd like to start off with Liam.
Thank you very much. I mean, there's so many things I could talk about. Some of those specialist sectors that we touched on, like data centers and so forth, and urban logistics, the areas where there's real growth right now. I think if I was being maybe sound a bit boring, but I think the potential for repurposing secondary office space is really significant. Not just conversion to other uses or conversion to residential, but actually in the majority of cases, I can think of areas in central London and in Manhattan where there are good buildings that really need repurposing and redesigning, and actually the ability to either redevelop or up-spec property to meet green requirements, to meet the requirements of modern occupiers is significant. And actually, an intelligent refurbishment of an office building can add significant value, particularly as companies start looking to their HQs to do more and add more value to their employees and their productivity. The other area that I would touch on, and you'd probably say, well, I would anyway, but is London prime residential property. It's a sector that saw 25% price falls over the past 5 or 6 years, and actually it's coming. Demand right now is incredibly strong, but it's coming out of the pandemic in a very sort of healthy position. So I think there's scope in the prime markets in London, and I think also in some of that secondary office space.
Liam, I think we could ask the same question to Karsten. Where would you put your $100 billion?
Well, if I had $100 million, of course, I would consider the services of a specialized wealth manager in order to structure my assets as efficiently as possible, right? I mean, that's clear. When it comes to investing, I think what is most important, especially in the equity market, is to diversify, right? To diversify within asset classes and to also diversify across asset classes, equities, bonds, real estate, just to name the most important ones. And equally important is to stay invested and not try to time the market. I guess we've all tried that, right? I would say, but most of us have not been very successful in doing that, right? Just last March last year, everybody would have sold into the down market, and most likely people would not have come back because they feared this pandemic too much. So this is a key statement we send to our clients, and we also take for ourselves, stay invested. Clearly, on the equity side, I do have a preference for my themes, the themes I'm looking at, because they are so tangible. They are related to how our world changes. I'll take future mobility. We think that by the middle of the century, 80 to 90% of all cars sold will be electric. So this is a huge opportunity. Take future cities with what we've heard before, but also with the expansion of the classical infrastructure, digital infrastructure, building technology. These things are going to shape our cities in the years to come. Take what I said before, genomics and digital health. We've just seen how unprepared some of our healthcare systems are for such a pandemic. And we do have the tools to make these systems more efficient, to make them more resilient, right? So this is another key area for me. And then with all these shift from offline to online, I think there is no way around cloud computing, artificial intelligence, and unfortunately also cybersecurity, because the more we put online, the more we are running the risk of being attacked. So these are clear secular growth themes from our side, which we would put our money into.
That's good to know, Karsten. Rick, how about you? Where would you put your 100 million?
Yeah. The real estate market, slightly different than the equities market is it's really a deal by deal approach. I mean, you go across the asset classes. The difference about this market now is it's anticipating the timing. And in this market, you do want to anticipate the timing because you're going to have significant opportunities from key people across different sectors. So I would go sector by sector and say, listen, I mean, if you can time the investment into the hotel and leisure sector, well, and you can actually get good pricing and you have the staying power to hang on, you're going to do extremely well. The same thing across, the office sector, that will come back. The industrial logistics sector, we know that's a winner. So, but the issue is trying to find a deal that makes a lot of sense. So I think the thing here now is, and in the real estate business, you don't need to buy the market. You don't need to buy the index. You just need to find those individual opportunities on a deal by deal basis. You need to find one distressed individual, one team that's undercapitalized, and those come from proprietary deals. So you can find opportunities, whether it's office, residential, industrial, retail, the hotel sector, and sometimes the more distressed, but the better the opportunity. But I'd look at on an individual deal by deal basis, because eventually this is the most distressed we will have ever seen certain parts of this sector, and no individual it goes through this unscathed. So there will be great individual deal opportunities across the asset classes as one-offs. So, and I think that is the opportunities here. So there's obviously a lot of people that have COVID fatigue. And so that is probably the best time to come in and start looking at your strategy. And don't look out over 12 months, look out over 24, 36 months, maybe 5 years, and you will see some life-changing opportunities.
Thanks, Ray. I guess there's the point that we try to look at the questions from the audience. We have here a question. I think this is a good topic to discuss. He's asking, what are your views on real estate tokenization? So he defined real estate tokenization refers to the division of a property into tradable shares or digital assets on a blockchain network. So many countries are doing this, but they have to have the legislative changes to create a friendly business environment. I guess his question is, what are your views on real estate tokenization? I think we can go first with Carsten.
You think I'm the expert on that? Well, we do look at the blockchain and crypto assets, of course, especially digitalization of assets. And I think there's a pro and there's also a con when it comes to this kind of topic. I mean, the pro is clearly that you can make assets available to a broader public, which you could not before, in the sense that you can really slice and dice these kinds of things, put it into smaller packages and then distribute it in order to also diversify. That's clearly a pro. It's also something which is going to make the whole thing more efficient in terms of transaction speeds, fungibility, etc. The con is that you basically translate an illiquid asset into a liquid asset. And that should ring a bell. That's what happened in the US subprime crisis as well, with these asset-backed securities, for example, which of course were not digital, but which followed the same principle that you took something which is illiquid by nature, such as real estate, and turn it into something which you can trade on a daily basis. In normal times, there is no issue with that because there's sufficient liquidity to facilitate the market making. But in crisis times, when liquidity dries up, suddenly you have an overhang of sellers, you have buyers disappearing from the market, and prices will plummet as we've seen it in US real estate. So I'm a little bit torn. I understand the concept, I see the idea, I appreciate the advantages, but from a financial research perspective, it's always difficult if you want to make something more liquid than it actually is.
Thank you, I think for this question, I'll have to throw this to Rick. With regards to Philippine property prices, there does not seem to have any decline despite the pandemic. Properties here are higher than many neighboring countries. Does this mean the bubble does not pertain to the Philippine market? Do you see property continuously increasing here?
Yeah, no, good question. Across the asset classes, if you're in Forbes Park, you haven't seen decline in property pricing, but if you've got condos in BGC, you've definitely seen prices drop and rents drop, anywhere from 20 to 30, 40%. So across the different asset classes, retail's obviously gotten hit extremely hard. And so you've definitely seen asset values drop and basically rental rates drop. So the industrial logistics sector has been strong. So I think we've seen some opportunities where anybody's, people saying, hey, listen, I've run out of cash. I'll sell my property to 40 to 50% discount. So we are seeing individualized distressed opportunities. Yeah. I mean, with the residential pre-sales, those have pretty much stopped. On the residential side. So, but you are seeing a lot of trading in the secondary market in the Philippines. So, no, definitely the Philippine market is not immune from global trends. The market is not as liquid as other markets. So you will see more trading at reduced prices. It's definitely a tenant's market. It's definitely a buyer's market. It's definitely a market that this year will be the year for deals and trading. So people will be forced into that situation. And banks will also be looking to basically, whether it's calling loans or they're already setting up some individual, asset management companies as well. So real estate will be affected. There will be price drops, and there will be rental rate drops, and there will be cut rate opportunities.
Thanks, Drake. We do hope that we can answer all the questions given by the audience. Unfortunately, we won't be able to answer them live here, but we will be answering them via email. So we will be responding to all your questions over email, and it will go through all the panelists. That being said, I now turn you over back to Bambina.